Hey you guys, welcome back to the channel. My name is Brad. This is the Firefighter's Financial Toolbox. As I get closer and closer to retirement, I've begun looking for different options to help pay for my retirement. Now obviously I have savings, but the idea of just drawing down all of my assets makes me a little nervous, particularly right now when bond yields, for example, are at a 30-year low. So I've been looking for other alternate investment options. And one of the ones that's come up and I've seen a lot about lately is the Nationwide Risk Managed Income ETF, ticker symbol NUSI, NUSI. Now, this is a relatively new fund, but the idea is it uses a system of covered calls and protective puts to give you a little bit extra monthly income and reduce a little bit the damages of a bear market. So it's going to limit your downside risk. Now, quickly, we're going to take a look at their fact sheet. Now, as we said, you guys, now this is a brand new fund. It's only been around since December of 2019. So it's a little over a year and a half old. So obviously we don't have a lot of long-term data, but I like some of the stuff about it. One thing I don't like, and I would never make this a primary holding, but I think, and we'll talk about how I think this could be a satellite holding in your portfolio, is the fact that the expense ratio is 0.68%, you guys, 68 basis points. That is pretty expensive. In my world, I like to keep it under 0.2 or even really under 0.10 if possible. Now, that's not universal. Obviously, some of my 457 plans are a little more. But the ones that I invested on the side, I keep low. Now, this works off the NASDAQ 100 index. The investment strategy here, and it's a 4-step process. It purchases all the stocks in the NASDAQ 100. So it's got all the NASDAQ 100 stocks. It'd be the same as buying QQQ, right? It also deploys a rules-based options caller strategy. That's what we talked about. So it uses covered calls to get an increase on the upside, and it puts protective puts on so that if the stock does go down, it doesn't go down as far. It distributes monthly income, and you get premiums and equity dividends. The other thing it does is because of the way it pays out some of its distributions, the taxation are a little bit nicer for you as far as that goes. The other step 4, the additional premium may be used to reinvest in the underlying portfolio. So they take some of that money that they've made, they put it back into the portfolio. If we take a look at the top 10 holdings, you guys, these are holdings we would expect on a lot of big funds. Apple, 11%. Microsoft, almost 10%. Amazon, 8.28%. Tesla, 4.2%. Facebook, 3.8%. Alphabet C, 3.6%. Alphabet A, 3.3%. Nvidia, 2.7%. PayPal, Intel. These are companies we know. And we know that it holds all 100 securities from the NASDAQ 100 index, right? If we look at the sector allocations, information technology is huge, you guys, over 48%. Communication services, a little over 19%. Consumer discretionary, 18.3%. Healthcare makes up about 6.5%. Consumer staples are a little over 5%. And then industrials and utilities bring up the rear. So let's take a look again at how this works. The way it works is it's an income solution that targets high current income and seeks to provide investors with the measure of downside protection in falling markets and a potential for upside participation in rising markets. So it's not going to go up as much as an S&P 500 or a QQQ. When Facebook and Amazon are climbing exponentially, this isn't going to get as much growth on it. But you guys, this is monthly income. And the reason it interests me is because it's a steady or a secured monthly income coming in for me during retirement. And remember, it's got that protective put. So if it does go down a little bit, it's not going to be as hard to stomach. So why would you choose NUSI? It's easy. It targets high monthly income. That's what we've been talking about. A rules-based options trading strategy that seeks to produce high income using the NASDAQ 100 index. It also seeks downside protection. So it uses a constant, fully financed market hedge that seeks to reduce downside risk. You guys, this is the part that I like. When I get to my drawdown phase, when I'm in retirement, after I've built my nest egg, I don't want it to go down if the market crashes. So this is a way, and it says in the third, potential risk mitigator. It seeks to limit duration and interest rate sensitivity risk. Because it's not going to go up and down as dramatically, it's going to be a little bit smoother ride if you're in retirement. So how do we use NUSI? Like I said, I would not consider this a primary holding, you guys. But I think it's a good way to complement a traditional allocation, whether it be, this says 60-40. I'm probably going to be more about 75-25 because I will have a small pension as well. It could be used as a bond alternative because we know even long-term bonds are giving about 2% right now. And so if I can get a little bit higher, I'm going to. And as we saw in that first slide, this is producing about 7.9%. The trailing 12-month is about 7.85%. Now, is it going to stay that high? I don't know. But it's one that I'm keeping my eye on right now. It also is a volatility dampener, and it may be a tool in supplementing current income. And that's why I like it, you guys. This is the reason I have dividend stocks, because I know that when I collect that dividend, it's going to be a lower taxation rate, but it's also going to be a steady quarterly income from our companies that will pay me forever. And this is another tool I'm looking at as a possible way to pay me forever. All right, so let's take a look at this graphic. It says here, the cost of living in the United States has more than doubled since 1985. More than 3 out of every 4 pre-retirees worry that they won't have enough income in retirement. Generating income in a low-rate environment is a true conundrum, and this is true. With yields on the 10-year Treasury bonds at or near all-time lows, bond investments, the tactic investors once used to make the safe investments for their income need, right, may be less productive than they once were. To make up the shortfall, many have been turning to non-traditional income-generating strategies. As we talked about, high dividend stocks, REITs. I hold both of those. Emerging market debt worries me because you have international price fluctuations in the currency that can affect that. High yield bonds, junk bonds. Bonds are for safety, you guys. I'm not a fan of high yield bonds personally, but they do pay a higher rate. And MLPs, you guys, I just made a video on MLPs as another strategy for that. But as we can see, they have risks as well. So why not consider a different approach to income generation? Use this as a tool for enhancing the income generating potential of a portfolio in exchange for some upside opportunity. Or use it as a hedging tool to seek protection against losses in a potential market downturn. So let's look at the 4 ways this can work. Obviously, cost savings. Investors can obtain options positions at a high cost saving relatively to securing positions in individual stocks. A lot of people don't have the money to go out and buy enough stocks to buy covered puts. You have to have 100 shares to do options. It gives you greater flexibility. Options are based on solutions positions. Investors capitalize on different market characteristics, including time decay and volatility. Have a higher return potential. Options may provide a greater upside potential when employed in disciplined, systematic fashion. And as we talked about, you have some enhanced tax efficiencies. Because this is classified as a Section 1256 contract, the taxation, if it is in a taxable account, is a little bit lower because of the way it distributes its income. So you guys, NUSI, the Nationwide Risk Managed Income ETF. It's something that I'm considering in retirement because of its income generation, but more than anything else, you're getting a monthly income, but you also have some downside risk protection that is ultimately important, especially in the first few years of retirement. If you have a big market crash and you're taking from a down market, you're really going to cripple yourself in how long your assets are going to last. So this is the one that I'm looking at and considering seriously, and maybe you guys should too. All right, I hope you got something out of this. If you did, do me a favor, drop me that like. It really helps the algorithm. If you're not already subscribed, you know the deal. Hit the red button, ring the bell. All right, we'll see you. Thanks.